what we're looking for is in this paradigm is going to be more volatile for all the uncertainty that we have. There's a lot of risk embedded. Things are going to happen. And I think the key thing is that investors build portfolios that are truly diversified. You cannot and should not be fighting volatility.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with money manager Diego Parrilla. If you haven't yet watched part 1 of our discussion with Diego, in which he explains the major challenges Europe faces and how they will play into the global macro picture from here, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. Diego also shares his advice for successfully navigating capital through the, quote, volatile and hostile market environment he sees ahead for the rest of the year. So be sure to stick around for that. Okay, let's get started watching part 2 of our interview with Diego Parrilla. The question I want to ask you is just sort of like, well, how bad do you think things are going to get? I realize that's a really big amorphous question. So why don't we try to focus it on sort of the next year? You recently wrote that you expect a, quote, volatile and hostile second half to the year as multiple risk factors collide. What are you watching most closely here? What do you think is going to be most important and sort of, how is this all going to manifest going forward? Are we going to see market corrections? Are we going to see economies tip into recession? Are we going to see more Sri Lankas as people rise up against governments that aren't able to, manage the impact that their populaces are feeling here?
Yeah, I think they're all happening at the same time. They're all interrelated, and I think the key driver of the markets is going to continue to be interest rates, particularly in the U.S. They're setting the pace. The view here and the key challenge is not only interest rates in absolute terms, but also relative to inflation. And in absolute terms, I think we will continue to see the Fed to hike aggressively. The higher equity markets stay, and with financial conditions being quite loose, the more likely they hike even more. And so, in some ways, this market rallies that we're seeing now, that a lot of people are scratching their heads, how is it possible that equities are doing this? There's a lot of pain on short sellers, on people that have been hedging. I personally think it's a good time for people to put on hedges, to be conservative. This rally is tricky. So I think the first thing is to watch is what's going to happen to interest rates in a market where equities are high. They will push as high as possible, and as they do that, eventually equities come off, yes or yes or yes. I don't see how. There's a scenario where inflation just collapses to levels of 2 to 3%. That I think it's unlikely. So my base scenario is central banks will hike. Those hikes will be notable, but will not be enough to offset inflation. So we'll continue to live in a negative real interest rate world, with inflation continue to be high, and the risks are on both ways. So from there, I think the other things key to watch is currencies and volatility. Volatility is particularly important, and I'm going to tie this up with portfolio construction. Okay, I use the analogy very often that when you build a portfolio, ultimately it's like a team. I'm European, so I use soccer. You could use different sports; they're all very similar. But generally, it's not just about scoring goals. It's also about defending and goalkeeping. And in that sense, we've lived through a period where it looked like you didn't need any defenders or goalkeepers. You could just stay happy with your portfolio of 11 strikers, And if anything went wrong, mommy and daddy would come in, the referee would whistle offside, and that was it, right? I think we're in a situation where the match is going to be much more volatile. It's going to be much more two-way. And I don't have a crystal ball. I don't believe in portfolios with 11 strikers. I don't believe in portfolios with 11 goalkeepers. And I don't believe the coach should be taking those kind of decisions. My view is much more, okay, guys, let's build a team that is truly balanced, okay, truly diversified, okay. And by this, what I'm emphasizing is the mistake, the risk of false diversification. Okay, many investors might say, look, I have a bunch of stuff in my portfolio. I'm diversified. Okay, say you have a crypto, right? You have 20 cryptocurrencies. That's not really diversified. Okay, you have a bunch of stuff, but everything goes up and down the same way. So ultimately, what we're looking for is in this paradigm is going to be more volatile for all the uncertainty that we have. There's a lot of risk embedded. Things are going to happen. And I think the key thing is that investors build portfolios that are truly diversified. You cannot and should not be fighting volatility. You need to embrace volatility. You need to basically be in a position where if the market rallies, great, I have strikers. If the market sells off, I have goalkeepers, and you actively rebalance. It's not about having a crystal ball. It's about having that team that effectively can take the ball, pass the ball, score, defend, attack. That is the key thing, in my opinion. And when you try to build the portfolios, there's plenty of strikers. In fact, most of the investment strategies out there on the long-only side tend to be risk-on plays. So I think my advice to people listening to us is this paradigm shift of arguably higher volatility, more risk is going to give opportunities on both sides. And we have to find positions where the portfolios are balanced, are truly diversified, and also I think we need to be very careful with position sizing. And I stress this a lot, but I think position sizing, there's the ultimate thermometer is your emotional distress, right? If you're trading and you are overly happy when you make money and you're overly sad, you're definitely trading too big. You want to be in a situation where you need to be careful with the leverage. Leverage is going to kill you in this environment, right? So we need to be careful with leverage, look for true diversification, and have position sizing that gives you a much more indifference in terms of what happens. The market's rallying, thank you very much. The market's selling off, thank you very much. And you are taking advantage of this by selling high, buying cheap, selling high through rebalancing. And this is the one thing that I'm basically emphasizing to investors. You need to take that long-term approach and embrace this volatility. Be careful with leverage and seek true diversification, because ultimately, let's not fool ourselves. Whilst volatility has been extraordinarily low, even in the last move down, the VIX sub 30 has been a bit of a surprise for many people given the sell-off we had. I think we're going to see a much more volatile period with those spikes, and at that point, it's not just about volatility, it's about liquidity, it's about correlations. Yeah, it's how the team behaves. And so it's I'm trying to give this cautious outlook that we're here for the long term and we need to build these portfolios thinking as a coach and the entire team. When people look at their portfolio with 11 stocks and they're all in green and they're very happy, that's a source of concern, because if they're all green, they could well be all red. So it's much better to find that true diversification, and that's what I recommend from an investment perspective. Having said that, there's going to be tactical opportunities and things that you can play. And from my perspective, as you know, our focus is much more on the defensive global macro, and I think there's a lot of value in the volatility space from these levels. There are assets like gold that I think are very well positioned for the medium long term. There are things like the dollar that I think continue to offer good value as a hedge. particularly against currencies such as China, where you have this divergence. There are pockets of tail risk and extraordinarily cheap insurance against different pockets, things like Hong Kong or even long-dated volatility or duration, which is also a great defender. So it's about building that team, that defense in a diversified manner, and to do that, it's an art, but it takes a lot of science as well. So our focus tends to be much more through the options market, through insurance, but again, I think each investor will need to build their own team. You're the coach, you decide how you want to play, and whether you manage yourself, your money, or you outsource some of it. I think just be prudent and look for the things I just discussed.
All right, that was a wonderful exposition there, and you are continuing a refrain that a number of recent experts on this program have been saying, which is active management is very important now in a way that people haven't had to appreciate much for the past 20 years or so. As you said, most portfolios were made out of strikers, over the past 10 years, and they did great because pretty much everything moved with a correlation of one, just upwards, because the coach or whoever was out, the Fed and central banks were out there, flooding the world with stimulus and support. So anyways, diversification, active rebalancing, those are all just critical elements of active management, as is portfolio sizing. And I had hedge funder Tom Thornton on last week, who was beating that exact same drum, Diego. So I'm glad that you added your own volume to that. Love your warning there about leverage in such a highly volatile environment, and this whole part about sort of embracing the volatility. I mean, that is a totally new factor to most investors, right? It's just been steady going for them, and so I think that in most people's cases, and of course I have a bit of a bias because this is why Wealthion exists, and we have financial advisors that we connect people with who understand all these macro issues, right? And so there's sort of several things that you need to think through as an investor here. Am I going to be the one to do this active management? Do I have the expertise to do it? If I don't, am I going to get somebody else? Well, if I go look for somebody else, do they have the expertise to manage this? And I'll let you chime in on here, but I think that there's a lot of quote unquote professional, financial advisors or even institutional money managers who have just ridden the rising tide, and that's all they really know how to invest with, and they may not be great people to steward your capital through what's going forward. So you need somebody who is aware of all of these risks that you were just mentioning, Diego. And even though we're talking about a paradigm shift from passive to active investing, from what you're describing, it's not just sort of average active management at this point. It's like this is going to be a highly uncertain time where you're going to need like active management on steroids to a certain extent. It's not like your garden variety active manager who, maybe was, managing stocks through the 60s and 70s. This is somebody who's going to, basically be able to be out there helping you dodge, a lot more bullets on the battlefield that you would normally see in a regular, type of investing environment. These are my words, but I'll let you react to them.
No, I agree. I think looking back to the fact that every single one of your investors, everyone listening, is effectively a coach. You need to decide, okay, what sort of strategy do I want to play? And my advice is think long term and think as a team. When it comes down to picking your players, you could have a player coach. So some people might be very good at stock picking, or a doctor or whoever might have an edge on certain fields. What is clear is that, as you mentioned, over the past decade, I think it's been the complacency and the markets we've had certain episodes where crisis occurred, but mommy and daddy would always come to the rescue, right? And that has in some ways perpetuated the problem or made it large. I think as you look to build your team, again, it's outsourcing some of that could make sense. And the good news is that you can actually pick as many as you want in some ways, right? So I'm not saying there's only one goalkeeper. There's multiple ways in which you can defend a portfolio, right? So I look at my peers or people in the volatility or defensive global macro space, and as we get to talk, whilst we might agree with the bigger picture where things might be heading, you look at the specifics of the portfolio in terms of timing, catalysts, themes, and you want to have some diversification across that. You want to be in a situation where, again, you create this barbell on the portfolio, and so the point is, some of those guys that are stock pickers that did very well still have a role in the portfolio, but they're not the entire team. They can be very good at picking X% of your portfolio, right?
Right. It's like having an offensive coach and a defensive coach, right? Not just one coach for the whole thing, but you've got a specialist.
And that is almost better. It's a good analogy because you want your strikers to score, right? If there's going to be few opportunities and you're going to have to take them. And the thing I keep re-emphasizing here by embracing volatility instead of fighting it is you want to be in a situation where things happen. You gave yourself that asymmetry, that optionality, that if equities are rallying like crazy now, this is the time to be, taking some profits on those equities so that you remain long, but you're taking some profits and adding insurance, adding goalkeepers. And when the crisis come and that insurance pays you a lot, it's the time to monetize that insurance and buy very cheap distressed assets. And as you do this, you're embracing the cycle. If you're in a situation where you're levered long, like many people have done and it's worked very well in tech or whatever, if you're levered long and the market corrects, not only you're not able to take opportunity of the distressed assets, you might even be taken out by the market through margin calls, etc. That's why I think leverage as volatility goes up is a very key risk factor. The other one is understanding these correlations. So you need to understand and accept that some things will make money, some things will lose money, provided things turn around and they complement each other. And as you do that, you're really embracing this volatility that is coming. Because then the power of compounding is huge. Just think for a second of a very, very, very simple portfolio, right? You have $100 and you have 50-50, striker, goalkeeper. As the market goes 70-30, 30-70, if you did nothing, eventually, if the market goes back to 50-50, that's where you were. You started at 100, you finish at 100. But if every time the market is 30-70, you sell expensive, buy cheap, and when it goes 70-30, you do the same thing, eventually, you may not end up at 100, you may end up at 120, 130, 150. The power of compounding in the long term is huge, and this is money that you make whilst you sleep. It's not about the manager being, oh my God, this guy's so smart, he knows exactly what the Fed's going to do or what the crisis is going to happen and when the war is going to end and when oil is going to peak. Nobody knows that. Nobody knows. But what we know is that, if you have these pieces in place and you rebalance them and you effectively compound on capital preservation, that's what makes you money in the long term.
Great.
It's too much focus.
Just to continue your analogy here of the team, it's don't stretch to try to win the playoffs every year. Just try to have a winning season every season if you can, and over time that will build the wealth that you're looking for with much less risk. Absolutely.
I think you wanna play long term. You wanna play with the it's almost like it doesn't matter. Our job as the coach is not to guess where the ball is going to be. Our job is wherever the ball is, have the right players to do the right job. And yes, you could be tactically thinking, you know what, we're going to attack a lot. Let's overweight the strikers. But things could happen, and you need the defenders and the goalkeepers. And if those guys can get the ball and pass it around, then you're going to be in a very strong position. I mean, for those who follow soccer, Real Madrid won the Champions League this year, and if anybody saw the final, you'd see that the goalkeeper was incredible. Okay, the number of saves he made. So if the other team cannot score, you can't lose. Okay, you may draw, but this is how incredibly important the goalkeeper is especially in low-scoring games like soccer, right? So again, this is emphasizing over and over the same issues, guys. At a big picture perspective, there's a lot of things happening. These are likely to lead to volatility. Your portfolio needs to be balanced. Don't fight it, embrace it, and to do that, I think the help of professionals, will always be, will add value because we complement each other, right? You have your areas of expertise, and some people are really good at strikers, at stock picking, at doing whatever in tech, fine. How much of your money you want to have there, and some others, like in the volatility or other spaces, all they do all day long is, okay, I'm the goalkeeper. When they shoot, how am I covering the goal, right? How ready am I, and how am I gonna pass the ball? So it's gonna be exciting. I think the people that are now being taken out from these hedges, arguably, should be keeping or adding. And I know this is painful if you've been too aggressive, either on the long side or the short side. So again, emotional indifference, as I call it, it's great because you're kind of happy either way, and emotional distress is terrible because it's going to make your life miserable and it's going to make you bankrupt. So I think too much leverage and too aggressive positions, too short-term focused, too crystal ball focused is your enemy. You want to have the team, you want to have the diversification, you want to play long-term, you want to embrace both.
All right, Diego, it's breaking my heart. I've got to bring this to a close because I still have a ton of questions I'd love to ask you here. We'll have to bring you back on again at some point soon to get into those. Real quick before I ask where people can go to learn more and follow you, just short answers to these quick questions. Are there, especially on the striker side, are there any sort of assets or sectors that you think will fare particularly well given this paradigm shift? And I'll give an example. Some people might make the case for commodities, right? To say that, hey, there's going to be, greater demand for what's out there because there's supply issues going on. I know that there's some complications where, yes, short supply does drive demand up, but we have a lot of demand destruction that's happening right now. That might bring demand for certain commodities down. I don't necessarily mean to make this a commodities answer, but are there any sort of sectors where you're like, I think that's going to do pretty well given this new world order we're entering into?
Well, I think for sure. I think real assets and commodity plays could have a role, but let me take one step back. I think on the striker side, you normally have equities and credit. So you could buy the equity on an oil producer, or you could buy a bond on an oil producer. Both are strikers in the sense that if the world does well, they do well. The problem and the big difference between them when you build this team, there are two dimensions. We've talked a lot about the strikers, midfielder, defenders, and that volatility angle. But the other dimension that ties in with our macro view is, are you long inflation or short inflation? And I think in that sense, you need to go for assets, in my opinion, that have a long inflation bias. So in that sense, look for sectors where you're going to be able to either make money or benefit from inflation. And for sure, you need to avoid things that will suffer from inflation. What do I mean by this? So if you buy whatever, in Europe, we have the stupidity of negative interest rates, right? So you bought a 30-year bond, which meant you pay 100, you got no coupon, and they gave you back $98, 98 euros, right? That was just stupid. But the key thing is that when you buy bonds, those 100 euros that you're going to get back in 20 or 30 years, the reality is they're going to buy you nothing. So effectively, you're short inflation. So I think on the striker side, even if I would favor equities to credit, and I would look for assets that will be benefiting from inflation, either because they have purchased, they have the ability to pass that on, or they get the benefit from inflation. Be careful with the sectors that are either the underlying itself, like a bond, is short inflation, or the company itself might be squeezed by inflation. Even something like Tesla, which I'm not an expert on, if lithium prices go through the moon and electricity prices are super expensive, there's a case where they may not be long inflation.
Okay, great. All right, and then last question. We had investor Louis Gov on the program not that long ago, and he's from Europe originally and has a very global macro view. He basically said, I'm going to pretty much stay away from investing in European assets, at least until the strong dollar begins to reverse and the energy crisis there begins to ameliorate. Do you have sort of a similar general attitude towards Europe, or are there opportunities there that investors should be looking at right now?
Europe's very difficult. I would agree with him that right now, with the current energy situation and the way things are going with the dollar and the euro, the ECB hiked rates. I don't think they have much room to hike much more. And that's unfortunately for the wrong reasons, with sovereign debt and others. So I'm sure there are pockets in Europe where there's going to be great opportunities that's outside of my space, but there's not too many places to hide. I think whether it's especially on risk assets. A very interesting market could be real estate. It's not particularly cheap, but I think inflation will remain high and rates will remain deeply negative. And I don't think central banks are in a position to hike rates aggressively. So as we investors, this new paradigm shift we talked about earlier, it's really a paradigm shift where we move from thinking in nominal terms to thinking in real terms. That's the real paradigm shift, okay? So if you give money to your financial advisor, in the olden days, you give him $100, he makes you, here's 101. We lived in a world of nominal rates and nominal returns because inflation was negligible. Today, the game has changed. You may take 100 and get back 101. Unfortunately, if inflation is 10%, and that's official inflation because real inflation is way higher, it's a very different game. So I think as investors, the paradigm shift is we are moving to thinking more in real terms. And I think in that sense, there are certain assets where you could see that the value, but overall Europe tricky. Real estate is also very tricky, but I think as a real asset where we're not going to be able to hike interest rates aggressively and inflation will remain high, I think it's possibly a good way to be and where I'm personally quite invested. But overall, I think this paradigm shift of nominal versus real is something every investor should be thinking very, very hard about. And that means at first, let's try to minimize assets that are short inflation because your purchase power, your real wealth is going to diminish. So we have to, this new paradigm is all about, I think, inflation.
All about protecting against inflation. Okay, great. Well, yeah. Diego, thank you so much for giving us so much time. Like I said, I really look forward to having you back on the program again soon. For folks that have really enjoyed getting to know you through this conversation, would like to learn more about you and your work, where should they go?
Well, they can reach out through Twitter if they want, at Parrilla Diego, R-L-L in Parrilla. And they can also reach out through LinkedIn. If you connect through Twitter, you'll see there's a free newsletter called the Anti-Bubble Report that I publish every month. And if people want to know more about the strategies that we manage, then they can basically respond to email to the newsletter or just DM me on Twitter or whatever. But yeah, I'm not hugely active, but I enjoy it. I like to feel the pulse of the market and the views, and generally I tend to be more reactive and respond to outrageous things or comments that I might see that are either crazy, misleading things or just food for thought, very, very thoughtful analysis or things that make you think. So I think Twitter could be the one way to reach out, but if anybody wants to know more through Twitter, we can actually get the indirect contact through email.
All right, great. We'll put up your Twitter handle on the screen when we edit this, as well as the anti-bubble report. Diego, thanks so much. Really appreciate this great discussion. Look forward to having you back on the program again soon. Good luck weathering through everything that Europe's going through, given that you live there, my friend.
It's been my pleasure, Adam. Thank you so much, and best of luck to everyone. Look forward to connecting soon.
All right, well, now is the time on the program where we bring in the lead partners from New Harbor Financial, one of Wealthion's endorsed financial advisory firm. Today, I'm joined by John Lodra. Mike Preston is away today. John, thanks so much for joining us this week.
Thank you for having me, Adam. Always great to be here, and always great to be able to digest some of your awesome guests and the markets that we're looking at every day.
All right, well, a little bit of a crazy day in the market, it seems. But first, let's talk about the interview with Diego here. I imagine a lot of what he said was probably like-minded with you and the team there at New Harbor. But what did you take away most from that conversation?
Yeah, well, I guess first, kindred spirit in that he's a Spanish national. I have a Spanish surname. We both have double L's, so that that was a common thread that it just reminded me I got to get back to my home country where my grandfather emigrated from. At some point in my life, which is on my bucket list. But I always appreciate when you bring folks that have a more worldly experience. I believe earlier in his career, if I'm not mistaken, he was in Asia, Singapore, if I'm not mistaken, and back in his home continent of Europe. But it's really I think helpful to get perspectives of folks who are in other geographies, other locations on this globe, and on the ground kind of observations like he shared with us. But yeah, I think he covered a lot of the big picture thematics that we have certainly kind of bought into or observed. The unmistakable impact of central banks and the dilemma that central banks find themselves in globally, and a diversion of courses between some central banks, with China easing at the time where here in the US we're tightening, and even in Europe we're tightening, even though, as he put it, the market's freaking out that they're tightening to zero, tightening up to zero, which just basically says it all right there. But he used the analogy of what central banks have done in terms of all going down the path together is not a dissimilar analogy to nuclear proliferation, right? Countries have gone down the nuclear path over the last several decades to the potential outcome of nuclear annihilation, and it's I think a very fitting analogy to what central bank policies have done blindly, not blindly, but in concert together, gotten us to a point where we have a real big problem on our hands that is almost intractable, probably, and almost certainly not escapable without some pain in the form of either inflation that can't get controlled, or a deflation of the asset price bubbles that have been engineered across so many different asset classes. So he talked about a paradigm shift. We absolutely agree. The next decade or two or three, we think is going to be a heck of a lot different than the last 3 or 4, which, from a broad standpoint, was all about declining interest rates, disinflation, all these things that are, we think, in a paradigm shift, which is much what Diego, I think, alluded to in his comments.
So you're right. He did use the term paradigm shift a lot. I'll also just say too, it is valuable to get the ex-US perspective, and I will say it is sort of sad to see in some ways Diego and Louis Gove, who I mentioned briefly, who I interviewed on this program a couple of weeks ago, both basically say we're so sort of unoptimistic about Europe's prospects right now that from a capital allocation standpoint, we just don't really see any good reasons to be investing in Europe right now. We think its prospects for the foreseeable future are bad and getting worse, and therefore we're going to be looking, to other markets to preserve our capital. Understand the reasons why they're saying that. It's just it's a sad commentary on actually how bad things are right out there right now in Europe. But yes, he used the term paradigm shift a lot. I think something that he underscored here, which I think is really worth talking about for a moment, is that things are going to be a lot more, from his lens, things are going to be a lot more volatile going forward. And really a lot of his investing strategy sounds like, I want to defend against, the downside risk of that volatility. But from an investing standpoint, my job is going to be to try to sort of ride the volatility, right? I'm going to try to position when I think it's more likely to go up, and then position when I think it's more likely to go down. And that's how I'm going to get my investment return out of this new era, which I think is, understandable. And I don't know if I've talked too much about that specifically with too many of the other capital managers on here, but I'm curious, John. I know you guys have been highly defensive getting to this stage, and I'm curious, as you peer forward, if you think that you may switch your investing style to something more like what Diego is saying, where, if I can use an analogy, maybe you guys have been sitting on the beach because the waters look too treacherous, but at some point, maybe what you might do is get your surfboard out and start, surfing the ups and the downs, in terms of, again, trying to get your investment return. Maybe I'm murdering that analogy, I don't know, but let me hand it back to you here, John. Do you see things perhaps changing in that way, sort of the paradigm shift for investing that Diego was referring to?
Yeah, I think it is a very possible, maybe even likely part of that paradigm shift. Look, we can look at data, reliable data that has strong historical statistical correlation, and make a very reasoned conclusion that not only is it possible, but likely that markets have ultimate downside in them to the tune of 40, 50, 60% or more down from here. As we sit right now, even with the now fairly modest pullback from the all-time highs, we're still at nearly 3 times the valuation that has been the norm over longer periods of time, that would be consistent with the kind of returns, say double-digit 10% returns that stock investors have come to believe are their ordained right. At present valuations, based upon that same data, over the next decade, stocks are likely, broadly speaking, stocks are likely to return negative returns. It's just when you get to such extreme valuations. But that's a big picture kind of view over the next decade or so. And that reliability of those kinds of forecasts it becomes stronger the longer you look out. Those kinds of valuation metrics have very little kind of value, I suppose, in the very short term. And we've been saying on your program, Adam, with you for the last several months here, that we think we probably are in a kind of a new secular bear market, but one that will likely see many very sizable rallies that will have the look and feel of, wow, we're glad that's over. We're off to a brand new bull market. And in fact, we're in one right now. The market's down a little today, but the last several weeks have been a absolutely almost vertical rise in the stock market off the mid-June lows. I can say quite humbly, even though we were prepared and not only willing but wanting to kind of play a tactical bounce there, we missed the ship on this one. We had a disciplined entry point that we were just shy of reaching, and the market took off. So a desire and an intention doesn't always execute per plan, and we're humbled to say that we've missed this short-term tactical rally. We think it's gotten very long in the tooth, and we think that today's downside is probably was probably very likely to happen, and we think there'll be further downside from here. But absolutely, we will look for opportunities to play like we did earlier this spring. We did indeed put a tactical long equity exposure in and sold it very shortly thereafter on a bounce. We absolutely believe that is one way to not only add value, but also to help keep wits. These kinds of short-term tactical rallies can be devastating to psychology, because each one that someone misses, the more intent they're going to be to say, well, I'm not going to let that happen again. And they end up getting jumped in at the wrong time, without the discipline to sell or take defensive action. So couldn't agree more with Diego's comments about needing to have both strikers and defenders and goalies on the field at the same time, or at least being in our role as coach, which is what we think our job is, not to predict markets as much as to put the right players on the field at the right time. And sometimes you want to stack the defensive side of the field. Sometimes you want to stack the offensive. And I'll take the analogy even further. There's this notion of field position in American football anyways, where the offensive plays you're going to run with your back to your own goal line are going to be different than the kind of offensive plays you're going to want to run when you're knocking on your opponent's goal line. The risk and reward of doing a screen pass to the side is a hell of a lot different when you're at your own goal line, where the opponent can intercept and dance 2 yards into your end zone versus at the other end of the field. So totally agree with that analogy that Diego used, but we do think it's going to be really important to navigate what we agree are going to be much more volatile markets, even if the overall path is downward. And that's why it's important to have that big perspective, but also have the nimbleness. And here's the thing, I mean, playing these tactical short-term moves can be done with risk controls. It doesn't have to be a all in, all out kind of decision. So for example, we oftentimes will use options hedging strategies in our approach, where we can have the fortitude to try to tactically play some short-term moves, but have some risk buffers in place with those hedging strategies. Long-winded answer, but I totally agree. And part of that is having the humility to know you're not always going to get it right. And I can tell you, we're scratching our wounds a little bit here in this recent one.
Yeah, well, appreciate the transparency there. And again, folks, this is seeing in real time how the game is played here by the guys that manage capital, right? Sort of like a coach, you're calling plays. Not every play is going to be a first down. What you're trying to do is just on average advance the ball in the direction that you want it to go. And you guys at New Harbor, and don't let me put words unfairly in your mouth, John, but given the current market environment, you guys are prioritizing defense versus offense here, just because, as you said earlier, valuations being what they are and risk factors being what they are, the preponderance of risk is to the downside. So better to miss one of these, potentially short-term rallies, but keep your principal protected versus overstretching and being vulnerable to a market downdraft. And one of the things we've talked a lot on this channel recently is okay, are we in a typical bear market rally that suckers people back in, and then the bear returns to maul them? Or is this something more substantial and a resumption of a bull move here? And it seems to me that you still believe the former. Certainly correct me if that's wrong. But if that is indeed then the case, then it's not the time to stretch to maybe get those last nickels in front of the steamroller. It's better to just be prepared in case things reverse here. And if it doesn't happen, well, then you have to figure out what plays to call next, right?
Yeah, that's exactly right. And the other thing that I want to pick up on that Diego referenced was the concept of position size, right? There is this notion that you can be tactically positioned for shorter term moves, but do so in sizing that is appropriate for the risk reward of that, right? All to say that here at these nosebleed valuations that we're at right now, our inclination is to, when we do put tactical long trades on, it's going to be with robust hedges and an overall position size as a percentage of the overall portfolio on the smaller side than if we were, for example, 50% lower than where we are right now. We would be inclined to have tactical positioning that would be less insistent upon robust hedging, likely, but also be willing to put more of a sizable position because the relative risk rewards would warrant that.
Right. And, I interviewed hedge fund analyst Tom Thornton last week. John, I don't know if you saw that or not, but his portfolio that he makes publicly available is up, at the time I talked to him, was up 27% for the year. So he's definitely doing something right in this environment. And he attributed his success I said the principal reason why he was successful there was because of position sizing. He said that's his number one priority when it comes to portfolio management, and said that no matter how much he falls in love with a stock, he never has a position size that's above 5%. So he's usually about 2 to 5% is the range in which he holds. And if it gets above 5%, he then immediately rebalances. Right. So I'm glad you underscored that. One other thing that Diego mentioned that I think is really important, and it sounds so old school and obvious, but he said, look, what you want to do is you want to position and manage the portfolio such that you're taking advantage of the power of compounding over time, right? Which, this is sort of investing 101, but we have an investing culture now that's much more about stretching for the home run, right? We've become a much more speculative society, both in terms of people's behavior, in terms of reaching for yield and reaching for risk, that I don't even know if in the mind of younger investors these days, if compounding really is even something they think about when they invest. They're just trying to see, hey, will this stock, meme stock, will this crypto, will this whatever, will this thing double, over the next couple of months? I mean, they're always up there swinging for the grand slam, when we've got centuries of investment history that just says, look, if you just play to the math, it'll take care of you over time, right? And so, just not trying to reach for unnecessary risk, but playing your team in a way where you're trying to get those incremental gains so that the compounding can just, do its magic over time. It was sort of refreshing for me to hear him underscore that again. I see you sort of smiling as I'm saying this.
Yeah, that's I couldn't agree more. I got a good chuckle, well, not a chuckle, Adam, because you posted something of a somewhat personal nature on your Twitter feed, I think even yesterday, regarding doing some personal finance education with your daughter, I believe, and opened up a instructional account, or I don't want to call it a play account, but a educational account with her. And within a short period of time of doing that, she or you, on behalf of her, were getting inundated with tantalizing, baits to, learn how to use margin and speculate with speculative options positions, as if the way to make money is find the easy path rather than the hard path, right? It's all roses and peaches and cream, right? If you use these tools, because it can only make your returns that much better, right?
So yes, that's exactly true. So for folks watching who didn't read the tweet, I have a 15-year-old daughter, and she came to me and said, "Hey, Dad, I'd actually like to start learning a little bit about investing." And so I said, "Well, let's open an investing account, and I'll put a little money in, and you can, start your journey." So we opened a Robinhood account for her, because that is the platform that younger kids are using for this type of stuff. And I will say they've done a very good job in making the interface really easy and intuitive for this digital generation. Now, the deal we have is that she runs every trade by me, and at the end of the day, the account's in my name. And so she has me as a mentor for this, but because the account's in my name, I get all the marketing emails that Robinhood is sending out there, and they're exactly what you just said there, Mike, John. And let's go back in time, 10 years, maybe not even. Options, you guys use them, but you guys use them as a hedge, and options are a very specialized instrument that carry a lot of risk if you do not know how to use them correctly. Certainly if you're doing naked options trades, right? And they're really not for the average investor. I mean, you really have to have a lot of experience before you as an individual investor should be employing them. And yet now they've just sort of somehow very quickly become the sort of standard go-to way to invest for the younger generation. And again, it's all to dial up the leverage to try to hit that home run, right? So the fact that they are, I think there's something like $150 in this trading account. The fact that Robinhood is carpet bombing accounts with that little cash in them to go long naked options is just absolutely ridiculous. I think immoral, but certainly not in the best interest of the users. You're basically just being marketed the products that the that these brokerages are trying to make their money off of. So anyways, long story short, it goes back to the point I was making, which is, Diego's point about just, hey, play the game prudently and position yourself to be able to let compounding do its thing. Again, it's so old school and maybe obvious to those of us with some gray in our beards, but I think that is actually a new and somewhat foreign concept, sadly, to today's younger investors. And to me, I just think that's criminal.
Yeah, the one thing I don't mean to be the cold water on the fire here, but compounding does work both ways. When you think about the economics of loss, if you invest in $100 and you get a 20% return, and you're at 120, a 20% loss from there brings you down below 100. To put it more starkly, if you lose 50% on your investment, you need 100% subsequent return to get back to even. So the larger the decline, it becomes a nonlinear, much larger gain you need to kind of get back to even. And that's the power of compounding in reverse. It can wipe away capital and literally take away years, if not decades, of progress or savings or whatever metric you want to use. And that's why when markets get this far out over their skis, record high valuations, only time in history that we have been higher than today have just been in the last year or so. We're beyond 2000, the tech bubble. We're beyond the 1929 peak before the Great Depression. But not only are we in record high valuations, but we have record high corporate margins, which have historically been one of the most mean reverting data points. In other words, it's about as good as it can get right now. So there's so many things that are stacked that can provide or can be the source of what I just referred to as negative compounding. That's why we think being so defensive, so at least mindful of the downside is critically important, because it can wipe out years, if not decades, of these short-term rallies that keep wanting to tempt people in.
Right, and that's why risk management is so important. It's a huge reason why we've been referring people to you for over a decade, John. At least I've been referring people to you over a decade. Wealthion's been doing it since we founded it a little over a year ago. And again, going back to Diego's sort of analogy there, to your point, it's less about getting the first down every time. It's just more about, with every play, it's more about just making enough forward advancements so you can continue to get to the next first down, and letting the positive compounding do its magic, and not losing yardage because you're making risky throws or calling risky plays, and then the negative compounding does the damage that you just talked about there. All right, so we're gonna have to start wrapping up here, John, but to my point about kind of the dangers of speculation, and even that speculation is sort of being sold as investing right now. The market today is sitting here on bated breath to find out what the Federal Reserve is going to do. And we've already railed about how, people can't really be investors anymore because the Fed is such an important player here. Everybody's just focused on trying to divine what Jerome Powell and a couple of people around the table are going to decide to do. But you mentioned that the market was sort of priced for perfection right now, and that's why you're more worried about the downside risk. What you didn't mention, although we've talked about this a lot, is there's a lot of factors that are trending to the downside here. We can talk about the slowing economy. We can talk about a lot of the bad data that's out there. But just the fact that we have a Federal Reserve and other world central banks that are engaged on a rate hike regime right now, an aggressive one, and perhaps the market is selling off a little bit today because maybe some whispers are coming out about what Jerome Powell is going to say or release in the next hour or two. Whatever he does, we'll talk about this and deconstruct it for you folks all next week. But we have the Fed raising the cost of capital, right, which by its nature brings down economic activity. We also have it now getting quantitative tightening up to its full $95 billion a month magnitude, that's really going to start weighing on asset prices too. So there are some pretty big pressures, downward pressures, that are going to be increasing in magnitude as we go forward from here. So that priced for perfection risk that you just said, I think we've got some real serious concerns that some repricing to the downside may have to happen soon, just given alone what the Fed's doing.
Yep, we can throw in a housing market that is very, very troubling signs of cooling off. Price drops, canceled offers, canceled new building starts. It's a really the pace at which those data have turned down actually in some ways has eclipsed even the steepest part of the housing decline in 08, 09. So not an encouraging sign at all. And one might think that, housing is separate from everything else. As we learned in 08, 09, it absolutely is not. Housing is such an anchoring or platform situation in most people's psyches as relates to the economy and wealth and stability. Throw into that job markets that we're seeing layoffs and hiring freezes. We can keep going on and on.
Yeah, and the only thing I'll just mention about the housing market that you said is in many ways it is more important to the national wealth effect than the stock market, simply because so many of the financial assets in the stock market are owned by the top 10% of households, whereas housing is much more widely owned. So a decrease in home values hits many more people's psyches and then impacts their spending behavior.
That's right.
All right. Well, look, so we will comment next week on whatever the Fed announces in the next couple hours here, since we're recording this on Wednesday. I have to start wrapping this up, John. Real quick before I do, I'll just give you the last word. As I like to do every week, you guys are talking to real people, many of the viewers of this channel, week in, week out, hearing what their concerns are, what their goals are, et cetera. Any parting bits of advice for folks based upon the conversations you're having right now?
Yeah, the conversation we just had, Adam, and that you have with your guests every week, they're great macro level type things. We always like to bring it down to the individual level. Every client and prospective client we talk to has their own set of circumstances. We think most people want the same thing in terms of their hard-earned assets being well cared for and stewarded and grow over time, but also protected from declines. But any given day we might talk to someone who's not invested or very lightly invested to someone who's heavily invested, and the reality of the markets today is the same for those two people, even though they're coming at it from different starting points, right? So our job, we think, is to bring it back to their situation. For the folks that are heavily invested, at least encourage them to think about the reasons why they might want to be less so, and maybe dramatically less so. For those that aren't, encourage them that, even though broadly assets and markets are overvalued, there are areas of value and potential, and areas that one should be. We like inflationary type assets, like real assets, in other words, so there's usually something of good actionable point for us to discuss with folks, even though it might be different because they're coming at it from different starting points. So just bring it back to your situation, where you are in your life, and recognize what the current markets could do to that situation if they play out as probabilities and historical tendencies would have them likely do.
All right. And, as Diego mentioned, and you and I have discussed here, right? We may be transitioning into a true paradigm shift where sort of the nature of investing and what playbook worked in the past doesn't work going forward. And so in high times of uncertainty like this, folks, I'll just beat my old drum here, which is you should be, putting together an investing plan for sure that's that fits the new rules of the new era we're going into. In most cases, you're going to benefit from doing that by following the guidance or collaborating and building it with a professional financial advisor. There are many out there. Not all of them understand or follow the type of macro risks and issues that Diego and I were talking about. So do your due diligence and go find one who does. If you already have one and they're good awesome. Stick with them. They're literally worth their weight in gold. But if you're having trouble finding a good one, or if you just like a second opinion by one who does understand the issues that Diego and John and I have been talking about here, perhaps even talking to John and his firm there, you can go talk to one of the financial advisors that are endorsed by Wealthion. Completely free consultation. There's no expectation to work with them. This is just a free public service these guys offer. If that sounds of interest to you, just go to wealthion.com and you fill out the form there. It takes literally just a couple of seconds. Also, if you're trying to understand the rules of what's likely to happen next, really one of the best ways to get a really good understanding in a very short period of time is to attend the upcoming Wealthion conference next month, because this is the theme of the conference, where we're bringing in the top minds in money and the markets to basically, open their cerebral kimonos and show you exactly, the data they're looking at and what they think has the highest probability of happening forward from here in the rest of this year and heading into 2023. I've given a lot of details on this conference, so I won't go into a ton of it here, but just if you're interested in learning more about this, go to wealthion.com/conference. And you'll see, just the lineup there alone is pretty historic. We've got Lacey Hunt, Lynn Alden, Matt Taibbi, Grant Williams, Stephanie Pomboy, Brent Johnson. We've got Doomberg. We've got Alf Peccatiello. We've got Nick Gurley. We've got Rick Rule. We've got Mike Maloney. We've got Jeff Clark. John and his team will be there from New Harbor. We'll have Lance Roberts as well. So folks, it's an incredibly packed day of essential information like this. And if you can't actually watch the event live, everybody who registers will get a replay video of it. And if you register in the next couple of weeks, you'll lock in the early bird price discount, which is like almost 30%. So anyways, again, go to wealthion.com/conference to get more details on that. Thanks so much for joining me again this week, John. Whatever the markets do next from here, whatever Powell and the Fed announce later on today, we'll make sense of it for folks here on the channel next week. Everybody else, thanks for spending another week with us. Thanks so much for watching.
Thank you, Adam. Great to be with you again, and we'll see you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.